Hello everyone and welcome to my channel. Today I'll be doing my February passive income report. This is my first of such videos and I plan to do one on a monthly basis going forward. Let's take a look at my numbers. This month I made $125.88 in passive income from a few different sources. A little over 40% of this month's passive income came from credit card rewards. I currently have two credit cards. One is a basic cashback card, and the other is a travel rewards card with an annual fee. A lot of the folks I've seen on YouTube exclude credit cards from their passive income reports. However, I'm including mine for a few reasons. One, generally speaking, credit card rewards are not taxable. So this is one of the few ways you can make passive income that isn't taxed when you gain it or when you redeem it. I think it's pretty cool and something worth celebrating on a monthly basis. The second reason I'm including this is because I don't budget for sinking funds. I can understand why people who have certain types of obligations, like children or rental properties, choose to do this, but for me, savings is just savings. However, the points balance for my travel card is essentially my travel sinking fund, so I want to track how the points are growing. I actually got this card last January and plan to take 2 international trips in 2020. Unfortunately, this did not come to fruition, but I'm still holding on to the card for now. When I eventually redeem my points, I may downgrade that card to an option without an annual fee, but that'll depend on how my life is set up next year. The third reason I'm tracking this is because credit card points can be redeemed for cash value. This month, I earned more in rewards than usual since I bought a new laptop. However, on a month-to-month basis, I earn a lot more in rewards than I'm getting from my bank accounts and interest, so this is worthwhile for me to track. The way I spend, track, and overall manage my money is just what works for me. There's more than one way of doing things. I also realize that credit cards are not for everyone. Some folks really struggle with short-term debt. Often, carrying a balance on your credit card can cost you more in interest payments than you're getting in rewards. If this pertains to you, but you still want some passive income, consider looking into cashback debit cards to see if there are any financial products that meet your needs. My second passive income source this month was from interest in my checking and savings accounts, and this accounted for like 6% of this month's passive income, so a little over $7. For me, I first learned about a high yield savings account like 5 years ago, but there are a lot out there. Obviously, in the current kind of economic context, the interest rates are going to be a lot lower than they were, say, this time last year. At the same time, interest rates for high yield savings accounts remain significantly greater than the rates offered by the older, more traditional banking institutions like JP Morgan Chase and Wells Fargo. My next passive income source, dividends. What on earth is a dividend? Oh my gosh, I'm so happy you asked. Dividends are payments a company makes to distribute its profits amongst its shareholders. They're paid on a regular basis, often quarterly, and this represents one of the ways investors can earn a return on purchasing a stock. Not all companies pay dividends, and they can be quite low in some cases. However, dividends are nothing to sneeze at, and reinvesting them can help you continue to see growth in your portfolio in the long run. In the last quarter of 2020, I started getting more interested in dividend investing, particularly dividend growth investing, and I tried adding some securities with a higher yield to my portfolio. This is the first month of tracking this for me, and I had dividends paid out from 7 different stocks and ETFs. I purchased about 3.5 shares of AT&T towards the end of last year, which paid me a total of $1.79. Earlier this year, I also picked up 5 shares of CVS, which brought in $2.50 in dividends. I bought a little Lowe's in June 2020, and I have slightly under 2 shares now, which have brought in 97 cents for the month of February. I started buying Apple a bit before the rest of these stocks, so I first bought it in 2019, and after the stock split, I'm sitting at 40 shares, which paid me $8.20. I also bought Abbott Laboratories, and that paid me $9.62. And then lastly, I had a little over 84 shares of First Commonwealth Bank, ticker symbol FCF, and that paid me $9.29. So towards the end of last year, I also started picking up some shares of SPHD, which is the S&P 500 high dividend yield, low volatility ETF, and it's a monthly paying dividend ETF, which paid me out $2.32 for the month of February. So this month I also tried a couple strategies that were new to me in order to increase my kind of income that I'm getting from my portfolio. The first was Dividend Capture, also known as dividend swing trading. Dividend Capture is a timing-oriented investment strategy that focuses on buying and selling dividend-paying stocks. The way it works is basically that you buy a stock just before its ex-dividend date to capture the dividend, and then you sell it on or after that date. So, you have your gains locked in as far as the income is concerned. So you don't necessarily need to keep holding the stock for a short term, since it's a short term position. All right, so returns from dividend capture are not guaranteed. Some research indicates that stock prices decline at an amount equal to the dividend payout, so it's pointless to try dividend capture. However, large cap stocks with higher yields generally tend to be less impacted. Also, you have to hold a stock for at least 60 days for the most part to be eligible for qualified dividends. And this qualified dividend designation allows for more favorable tax treatment. So instead of being taxed at your marginal tax bracket, you receive a 0% tax on qualified dividends if your annual income is under 40K as a single filer. And then for other folks where your income is between 40 to about 440K, qualified dividends are assessed at a 15% tax, which is still going to be lower than your tax rate. So using the dividend capture strategy would have caused me to be charged taxes because I'm not holding the stocks for up to 60 days. However, because they were received in my tax advantaged account, since I was doing this activity in my Roth IRA, the dividend isn't taxed at the end of the year. At the same time, since IRAs have limited margin, I had to hold the stocks for 2 days. And if I sold the stocks for quicker than that, I could have been penalized by my brokerage firm for selling unsettled shares. So I tried dividend capture with First Commonwealth Bank. I purchased 84.467 shares for a total of $1,000. I sold all the shares 2 days later for $1,046 and some cents. So that represents a 4.6% growth in terms of simply the capital appreciation. And then since I gained $9.29 in dividends, that's a 5.5% growth overall compared to the S&P 500's 1.3% dividend growth over the same time period. So I beat the S&P 500 on this particular holding. All right, now I also tried dividend capture with IBM, and it wasn't quite as successful. So I purchased 8.483 shares for a total of $1,046 and some cents. I lost about $30. However, I will get $13.82 in dividends. This won't pay out until later in March. But yeah, that's a negative 1.47% return compared to the S&P 500's negative 1% return during the same time period. So I slightly underperformed the S&P 500 on this particular trade. I plan to use dividend capture again during March when a lot of dividend-paying real estate and utility ETFs, as well as individual REITs, are going to go ex-dividend. Additionally, a lot of my larger holdings pay out in March anyway, so I think I'm going to have some nice income to report during my next passive income report. The next strategy I employed was a covered call. Earlier in the year, I learned about the covered call strategy and how it can be used to generate cash flow. This was interesting to me since my portfolio has a lot of non-dividend paying stocks. I won't go into detail with this because I'm still in the learning phase, but perhaps in the future I might do a video chronicling my journey. So what I will say is that implementing covered calls can involve a significant concentration in a single position since you have to hold 100 shares of it. This can mean more risk. For me, I chose a stock that I had previously bought at around $8 per share, and I increased my holdings. Once I get more comfortable with the strategy, I'd like to use it in my IRA with an S&P 500 ETF like VOO. or SPY. So the lessons that I've learned so far, a big one for me is dividend reinvestment. I didn't have that configured on most of my positions until a couple months ago, and I missed out on some growth by having uninvested cash sitting on the sidelines. Even if it's just like a little bit, it kind of adds up over time. The other thing that I should have done better was for my short-term positions like IBM, pay attention to, okay, what point do I want to enter? What point do I want to exit? I didn't go into the technicals of it because kind of my goal was to capture the dividend, but I probably could have done a better job at like kind of automating that. And then with my covered calls, I should have paid more attention to like earnings dates. I use Shift Technologies for my covered call exercise. I didn't know it at the time when I sold the covered call, but they were initially expected to report earnings on the day my options contract would expire. Since the earnings call would have been after market close, I was still okay, but this is definitely something I should have paid attention to. Earnings reports are a huge determinant of a stock price, and that impacts whether or not an options trade is profitable. Thanks so much for tuning in. Let me know in the comments below if you've tried any of the passive income strategies I experimented with this month. As always, please like, share, and subscribe to keep getting some of this personal finance content. All right, see y'all next time.